Hey everyone, generally the retail investors get carried away with the short-term noise in the stock market. One good news can make retail investors greedy, whereas one bad news is enough to create panic among retail investors. Because majority of retail investors are driven by short-term sentiments. They lack conviction. As a result, they completely miss the long-term bigger picture. And let's be honest, stock picking is not easy. It requires a lot of research to identify quality stocks that have a bright future growth prospect, and most important aspect is to hold on to those stocks in your portfolio even during the fall. And in fact, accumulate those quality stocks on every fall. That requires a lot of conviction. And it's not easy for retail investors to do that kind of research and have that kind of conviction to accumulate stocks even during the fall. Another problem with retail investors is that we always want to identify the hot stocks that are in news and have probably jumped a lot in recent months. We don't like to invest in boring companies where the share price has been either stagnant for a long time or either falling. Because let's be honest, retail investors generally do not have the confidence to invest in a stagnant or falling stock. And that is where I thought, can I identify top blue chip stocks in India that DIIs, that is mutual fund houses, are accumulating on a consistent basis? Not in last 1 or 2 quarters, but in last 3, 4, 5 quarters or maybe more. And that too on a consistent basis. And if DIIs are buying a stock on a consistent basis in last many quarters, then surely there is something interesting with the company, isn't it? Maybe worth looking at it. So I did my research and identified top 10 blue chip stocks that DIIs are buying on a consistent basis. That would give you a good perspective and probably boost your confidence if you are already holding these stocks in your portfolio. Although this is not a stock tip, so make sure that you do your research before investing your money. Alright, let's get started. Number 1 stock is from FMCG sector. It is HUL. Let us look at DIIs buying pattern in HUL. DIIs holding in HUL has increased from 6.67% in September 19 to levels of 8.34, and then it increased to 10.82. Although there was a slight dip for the next 3 quarters, but again if you look at it from September 21, the shareholding has increased from 10.48 to 10.85 to 11.61, and latest holding is 12.2. So there's a consistent increase over the last 3 quarters. Clearly DIIs are consistently adding HUL in the portfolio over the last 12 quarters except for 2-3 quarters in between. Now what could be the reason for this strong conviction in HUL? Well, HUL is a leader in Indian FMCG sector with brands like Dove, Lux, Lifebuoy, Lipton, Brook Bond, Clinic Plus, Close Up, Domex, Lakme, Surf Excel, Vaseline, and the list goes on. 9 out of 10 households in India consume HUL products. And the consumption for these products will only increase in the future. And HUL has a highly profitable business with negligible debt. It is a free cash flow generating machine. No wonder, it is one of the favorite stock of many people, including mutual fund houses. Number 2 stock is from IT sector. It is HCL. Let us look at DIIs buying pattern in HCL. DIIs holding in HCL has increased from 8.42% in December 19 to 9.1 to 10.01 to 10.62, 10.25, then 10.54, 11.34, 12.47, 13, 14.68 and 15. So there's a consistent increase in the shareholding over the last 6-7 quarters. Now there are 2 reasons for mutual funds accumulating HCL. First, India is leader in IT sector all over the world with nearly 55% of world's market cap. We have the required talent base at much lower cost than developed countries. So Indian IT sector would continue to grow. And HCL is one of the top IT companies in India. The business model of IT company is amazing. You earn in dollar, pound, euro and spend majorly in rupee. Hence, HCL is another cash generating machine. Second reason is valuation. After the sharp correction in IT sector in last few months, HCL valuation has fallen a lot. Currently, it is available at a P ratio of 18, which is very attractive. Although due to slowdown in US economy, there are concerns over IT sector growth, but that is all short term. The long-term growth prospect of IT companies are still intact. And this current fall has made IT stocks even more attractive. No wonder, DIIs are utilizing this opportunity to accumulate top IT stocks like HCL. Moreover, HCL is also a very good dividend player. Then third stock is from pharma sector. It is Divis Lab. Let us look at DIIs buying pattern in Divis Lab. DIIs holding in Divis has increased from 15.46 to 15.47, 15.59, then 16.8, then 18.8. Although there was a slight dip from 18.8 to 16.8, then 16.74, 16.5, then 16.36. However, in last 3 quarters, again, DIIs have increased their shareholding from 6.36 to 17.7 to 18.8 to 19.98. DEVL is among the top leaders in the world in generic API manufacturing and a big contract manufacturer for global pharma giants. As far as future is concerned, there is immense growth potential in pharma sector. Although during the COVID period, pharma sector saw a huge surge in demand and the share price of pharma companies jumped a lot. But after the economy opened up, the growth for pharma sector has started slowing down. As a result, pharma companies have seen a sharp correction. The major reason was profit booking from pharma sector. Now, DEVL is still down 33% from its peak and available at a P ratio of 31, which is much lower than its historical average PE. Clearly, mutual fund houses are utilizing this fall as an opportunity to accumulate DEVL. Now, before we proceed further, we have a partner for this video. It's M-Stock from Mira Asset. Now, you can invest in stocks with zero brokerage cost using M-Stock platform from Mira Asset. It has a very unique pricing model where you don't have to pay any brokerage on your delivery trade, intraday, futures and option trading. There is only a one-time fee of $999 and with that, you can make unlimited trade without any brokerage. And if you open a Demat account with M-Stock, you just need to pay a one-time amount of $999 and your Demat maintenance would be free for life. So basically, you pay a total of $1998 and all your trading is free and your Demat maintenance is free for life. This is a great option for those who trade frequently and even for investors who are looking for low-cost trading option. If you want to explore M-Stock, I provided the link in the description. They also have super fast, stable and secure technology with super fast one-click order placement, stable platform for smooth processing and global expertise in technology support. Then you can also back your trade with fundamental data and technical charts with smart calculators for easy decision trading charts with buy and sell feature and fundamental and technical data. In fact, you can even do quick voice search for stocks. Next 3 stocks are from banking sector: ICICI Bank, HDFC Bank and Kotak Bank. Let us look at the DIIs buying pattern in each of these banks. DIIs holding in ICICI Bank has increased from 41.7% in June 21 to 42.49 to 43.75 to 44.58 to 45.33. So over the last 4 quarters, there is a consistent increase in shareholding from DIIs. DIIs holding in HDFC Bank has increased from 20.99% in March 21 to 21.46, 22.53, 22.97, 24.55 and latest holding is 27.11. Again, there is a consistent increase over the last 5 quarters. DIIs holding in Kotak Mahindra has increased from 12.92 to 13.5 to 14.6, 15.29, 15.49, 16.6 and latest holding 17.29. So consistent increase over the last 6 quarters. Friends, the reason for DIIs buying these top banking stock is simple. Banks are the backbone of an economy. And for Indian economy to grow, banking sector will play a crucial role. Moreover, banking sector in India is still underpenetrated. People in rural parts still do not have access to easy credit. And the demand for houses, cars, gadgets, everything is going to increase. That would directly result in increase in retail loan. Similarly, even the corporate and small and medium businesses would need loan. So overall, the top quality banks with a proven track record, strong balance sheet, high asset quality with strong distribution network are bound to grow. Moreover, the valuation of these banking stock is also looking attractive. ICICI Bank is trading at a P ratio of 22, HDFC Bank is trading at a P ratio of 21 and Kotak Mahindra is trading at a P ratio of 29. 7th stock is from NBFC sector. It is Bajaj Finance. DIIs holding in Bajaj Finance has increased from 9.07 to 9.08, 9.33, 9.73, 10.11, 11.22 to 12.03. So again, a consistent increase over the last 5 quarters. Bajaj Finance is an undisputed leader in Indian NBFC sector and it is expanding its digital presence to become a one-click financial supermarket with a super app providing both shopping and financial product ecosystem. It has launched its own UPI payment service, its own marketplace for insurance and loans, planning to enter into peer-to-peer lending and adding many merchants all over the country. Clearly, the potential is immense. 8th stock is from cement sector. It is UltraTech Cement. DIIs holding in UltraTech Cement has increased from 13.74% to 14.39, 14.51, 15.15, 16.39 and latest holding 18.16. So a consistent increase over the last 5 quarters. As far as future is concerned, Indian government has a huge focus on infrastructure building, and cement is one of the most essential products in building the roads, highways, ports, airports, bridges and so on. Moreover, the rising demand for housing and corporate building would also benefit cement companies. And UltraTech Cement is again an undisputed leader in cement sector in India. Ninth stock is from auto sector. It is Tata Motors. DI holding in Tata Motors has increased from 11.47% in June 21 to 13.3, 13.64, 14.38 and latest holding 15.17. So a consistent increase in shareholding over the last 4 quarters. With Tata Motors, DIIs are betting on the future of automobile, which is electric. So far, Tata Motors is an undisputed leader in Indian 4-wheeler EV segment. And it is just the beginning of electric vehicles in India. Over the next 5 to 10 years, the electric vehicle market in India is going to explode. And Tata Motors has already got the first mover advantage with its Nexon EV range of cars. Company has already announced the launch of 10 new EV cars by 2026. And let's not forget, Tata Motors is part of India's one of the most trusted business house, Tata Group. Clearly, DIIs are betting the leadership of Tata Group. That is precisely the reason, in spite of Tata Motors' negative earnings, DIIs are buying it consistently. Since Tata Motors earnings are negative, we can't have PE ratio. But if you look at price to sales, it has a price to sales ratio of just 0.59. It basically means Tata Motors' entire market cap is just 0.59 times of its last 1 year of sale. Tata Motors command a market cap of 1.68 lakh crore and its last 1 year of sale is 2.83 lakh crore. That translates to a price to sale of 0.59. Just to give you an analysis, Maruti has a price to sale of 2.83 times. Final stock is from credit card sector. It is SBI Card. DI holding in SBI Card has increased from 3.23% in September 20 to 3.9%, 5.97, 6.69, 9.71, 11.92, 12.41 and latest holding 16.24%. So consistent increase in shareholding over the last 7 quarters. The reason why DIIs are bullish on SBI Card is because it is just the beginning of digital transformation in India. Factors like India's strong macroeconomic performance, together with its large working population, aspirational young population, rising affluence, rapid urbanization, rise of e-commerce, and an increasing shift from cash transaction to card and digital payment will continue to propel the growth of India's largely underpenetrated credit card industry. SBI Card is India's second largest credit card issuer after HDFC Bank, and it is the largest pure play company in credit card business. Also, the fact that SBI Card enjoys a very strong parentage from SBI Bank, which has the largest banking network in India. Although the rise of UPI and other payment methods like digital wallet, buy now, pay later, etc. have emerged, which are creating competition for credit card sector, but the value for credit card is still intact and total addressable market for digital payment is huge. Hence, credit card companies like SBI Card would continue to enjoy a large pie from this market. So the 10 blue chip stocks that DIIs are buying consistently include HUL, HCL, Divis Lab, ICICI Bank, HDFC Bank, Kotak Mahindra Bank, Bajaj Finance, UltraTech Cement, Tata Motors and SBI Card. Did you notice a pattern in all these 10 blue chip stocks that DIIs are buying in their portfolio on a consistent basis? All these companies are leader in their respective sector. So DIIs are adding these leaders in their portfolio on a consistent basis. Now you might argue that DIIs are buying because in majority of cases FIs are selling. But even if FIs are selling, there is no compulsion on DIIs to buy the share. Even public can increase their shareholding, isn't it? So if DIIs are buying the share of a company on a consistent basis, then it clearly shows the confidence of domestic institutional investors in company regarding the future growth prospect. And let's not forget, FIs are the net sellers not because of weak fundamental in Indian economy. It is because of pressure to book profit from emerging markets like India. I'm sure eventually FIs will come back and start buying from Indian market. But yes, there's no guarantee that if DIIs are buying a stock on a consistent basis in the past, then they would continue to do so in the future. So make sure that you do your research and understand the fundamentals of the company along with valuation before investing your money. Now tell me, out of these 10 stocks, which stocks are you holding in your portfolio? And do you want me to do a similar research for mid-cap and small-cap stocks? If yes, do let me know in the comments. I hope you'll find this video useful. I'll see you in the next video. Till then, take care.
Investments in securities markets are subject to market risks. Read all the related documents carefully before investing.